We've got a full agenda, so we'll give us just 1 minute for people to assemble. Thanks. Okay, welcome to the Leaders in Housing Counseling call. We're glad you're all here. This is Bruce Storp-Halen from the National Housing Resource Center. We're going to have an active call today, and we have Julia Gordon from the Center for American Progress on the call. There'll be opportunity if you'd like to ask questions, and you can do those through the question box, or you can try to call in. You should do it through your phone rather than through your computer. And Matthew will try to keep an eye out for people who are raising their hand to get on the call to ask questions. But let's run through the agenda really quickly. We're going to do a quick update on the federal funding situation for housing counseling. We've done some good work there. The latest on the mortgage debt forgiveness tax bill, finally some movement. Then we'll have Julia Gordon working with us on housing finance reform, and then we'll spend some time on that, so that'll be the bulk of today's call. And then the latest on MHA, on the borrower intake and outreach program, and trying to figure out how to make it work a little better. The technology working group, which we started at the Leaders Conference in LA, and then just a couple updates on this new on the webinar we're going to do on HSBC's new loss mitigation rules, and making sure people are up to date on the website of CFPB. But let's dive right in. So first on our list is federal funding and where we stand on housing counseling. So Matthew, what's the latest?
All right, so just first by way of a quick just kind of recap, we went over this last call, but just want to make sure everyone remembers the numbers. So President Obama, in his proposal for FY 2015, included $60 million for the HUD Housing Counseling Program, which is an increase of $15 million from $45 for this fiscal year. And then he proposed kind of offsetting that with a $17.5 million cut to the NFMC program, so it would be $50 million rather than $67.5. So overall, it would be a $2.5 million cut to the two programs combined. So we talked about last time that our ask is for $60 million for the HUD Housing Counseling Program, and so they're asking for the President's increase, but not offsetting that with any decrease to NFMC. So asking them to keep it level funded at $67.5 million, which would be a net gain of $15 million. So hopefully everyone on the call saw in the last couple weeks, I guess it's been, that we circulated our sign-on letter, and it was a really huge success. We had 480 housing counseling agencies and some other non-counseling agencies or supporters of housing counseling sign on to the letter, which was by far, I don't know what the previous record had been. Last year we were in the 200s though, so this was really a great showing on the sign-on letter. The other thing that we mentioned and we did do that was really cool was included in every letter, and I actually am going to go to and just show you one of the letters we submitted to Senator Gillibrand. So we personalized every letter to the member of Congress that was receiving it. We included, you'll see here in the middle of your screen in bold, in New York, 12.7% of all mortgages. So we did that for every letter, so every person saw some information about what was going on in their home state. We weren't able to do it for district level for members of the House, but it was really nice that we had that there. And then I'll just scroll down a little bit more, and you'll see that the sign-ons were listed first by state. So the member, Senator Gillibrand, when she looked, the first thing, or her staff person more likely, looked and saw all these New York groups signed on. We had a great showing from New York, by the way, of more than 60 groups signed on. So that was the letter we submitted at the end of last week and the beginning of this week. So just first, a huge thanks to everyone who signed on, and also there were a lot of groups that did a great job of circulating it outside of our list, so that we got a lot of agencies signed on that aren't on the leaders list. So it really just a great job by everyone, and thank you all very much for that. The other thing to mention, in the House, Representative Gutierrez circulated a Dear Colleague letter, so that goes out to all the members of the House, asking them to sign their name to a request. His was for $60 million for the HUD Housing Counseling Program. Didn't include the NFMC program, and as far as we know, there wasn't any Dear Colleague letter circulated on NFMC, which is not really a huge surprise. But that was signed by more than 75 House members, so that was a really good showing. And then in the Senate, there's a Dear Colleague letter being circulated now by Senator Menendez. I think the close on that is tomorrow, so we should have a good idea tomorrow of what kind of support that got in the Senate. So now, just as far as well, I guess actually that's all we have for now for the housing counseling funding.
Good. So Matthew, okay, how many groups signed?
480 on our letter.
And how many states were represented?
So it was 48 states. So for the next time, we need to work on Kansas and South Carolina, but every other state had at least one agency signed on, and D.C. and Puerto Rico as well.
So we should definitely reach out to your friends in South Carolina, and in Kansas is the other one?
Yes.
Okay, and I hate to do one more shout out, but Nevada actually only had one group sign on. You're talking about a state in crisis, so we need to fix that next time. But this has broken all our records. So I was there for the previous record, which was when the housing counseling was zeroed out, what, 3-4 years ago, and we had about 440 groups sign on then. So we blew through that, and I don't think we had more than about 40 states represented last time. So we've really improved a lot. So that's very good and very helpful news. So, and the reason this is important is that this can be the driving force with a number of people in the House and Senate. So we were told repeatedly that you have to have correspondence from local groups showing support to get onto the letter that goes to the Appropriations Committee, or for people to do kind of outreach and stuff like that. So we did that. We've hopefully elevated housing counseling. We've heard some rumors that they hadn't been hearing much from the housing counseling community. This changes that. The fact that there's lots of groups signed up from individual states totally personalizes this and makes it much more valuable. So this is a tool that we'll use regularly. So please get your sign-on signature system down pat, because we're going to have to come back to you. The reality is that we're going to do this throughout the appropriations process until the budget is voted on, and there'll be steps where we'll need we'll have another letter, and we'll need another round of sign-ons to get people signed in, and this will be, it's all part of the process in order to get things through Congress. And the same thing we'll do next year. So this will all be things that we run through in upcoming years. So Matthew, what's our next steps on housing counseling funding?
Yeah, so I mean, you just kind of touched on the one of the two, but we will do another sign-on letter, which will be similar, but with just a slightly different ask. And we'll do that in the next, I think, couple weeks or so. So I'll apologize in advance, because I'm sure I'm going to be bugging you all with a flurry of emails when we do that. But it's certainly worth it when we get up to a huge number of signatures. So we'll be doing another sign-on letter. So look out for that in the next couple of weeks. We'll also be doing some Hill visits, meeting with staff people from the Appropriations Committee, from the committee staff themselves, as well as the staff for the members on those committees. And that's really, it's still going to be a long, ongoing process. So look forward to more updates and a few more asks from us probably.
All right, there you have it. But this is all important to keep the funding flowing, and position ourselves to make sure that housing counseling funding stays strong and, at those places where there's opportunities to try to expand it. Okay, so the other big piece is on the Mortgage Forgiveness Debt Relief Act. So Matthew, there's some good news finally?
Yes, there is. So this is, again, I'm sure everyone knows this, but just to quickly recap, so this is a bill that would protect homeowners from having to claim a principal reduction as taxable income. So as you all know, it expired at the end of 2013. We've been working hard to try to get it renewed. So finally, the Senate Finance Committee is voting today, and they have actually already voted, and if they did, we expect that it's going to pass when they vote on it today. So it's also, Leader Reid is a supporter, and so we expect that once it gets out of committee that the Senate will get to the Senate floor and the Senate will vote on and pass it. And so just to go back a little, it's not a standalone bill, it's part of a package of tax extensions. It has bipartisan support. Senator Hatch, the Republican from Utah, who's the ranking member on the Finance Committee, was a co-sponsor. So it's expected to pass through the Senate, which was obviously good news. The big still question mark, though, is what's going to happen in the House. We don't have good answers from that, and actually just had an alert beforehand, just before we started this call, that we now should shift our focus to the House Ways and Means Committee. So I'll send out an email with more details on who the members are, but that's going to be the next step for us, is going to be to do a little outreach, make some calls, generate some contacts to members of the House Ways and Means Committee. So I'll get that out after the call.
All right, always plenty to do. So our next topic is federal housing finance reform, and I'm delighted to have Julia Gordon on the line. Julia is the Director of Housing and Finance Policy at the Center for American Progress, and Julia's been one of the leading voices in housing legislation in the country and has been deeply involved in the debates about replacing Fannie Mae and Freddie Mac with new housing finance proposals, and has been always a progressive voice, and a voice that's been helpful to low and moderate income and affordable housing in this country. And we've had her before. She's been very helpful, and welcome to the Leaders in Housing Counseling call. Julia.
Thanks so much for having me. Can we hear me?
Yes, we can.
Okay. I couldn't tell from the little thing if I was on. I did want to add just to the last report that the tax forgiveness did pass out of the Senate Finance Committee. So, before it gets to the floor, they are asking for our help in reaching out to Ways and Means, and they're not exactly sure when it will come to the floor.
Great. So, so we'll be in communication with people about that. That's very good news. This is finally the breakthrough that it's finally moving, which has been one of the big steps here. Good. So, Julia, can you give us an overview on the new Johnson-Crapo legislation, and we're particularly interested on issues on how on access to credit and on how it might impact on housing counseling.
Sure. Well, there are many bills that you can describe in a few words. This is not one of them. It's a 442-page piece of legislation. It lays out a very complicated system with a lot of different types of both existing and new financial institutions involved. So I'm going to describe it briefly. I'm not going to describe it in enough detail to truly do it justice, but then I'll move into the topics that are really, I think, most of interest to the people on this call. So the basic concept, as I think people are generally familiar with, is currently Fannie and Freddie provide a number of functions all in one place, kind of a one-stop shopping. They can purchase loans, pool them into securities, issue the securities, and they also guarantee the timely payment of principal and interest on the loans contained in the securities, so that investors in those bonds only have to worry about interest rate risk and prepayment risk as opposed to having to evaluate the underlying credit quality of all of the loans. So that's the system we've got now. The basic concept of Johnson-Crapo is to disaggregate a number of those functions and replace the government-sponsored entities in some of those functions with private entities, and replace some of the functions with government, full governmental entities. So the way it would work is there would be private entities who would, of course, originate loans, bundle those loans into securities, obtain some kind of private insurance or something like insurance on those securities to a level of 10% losses on the securities. So if you created a bond, in order to get a government backstop guarantee, first you would have to have either a private insurance company or private investors through a structured transaction in the capital markets absorb the first 10% of losses on those bonds. After that, you would be able to access government insurance on those bonds, which you'll have been paying for as well, which stands behind that 10%. The government insurance is also priced and explicit and paid for. So the end result is a system where the taxpayer is protected by a lot of layers of capital, starting, of course, with the borrower's down payment, with any mortgage insurance on that individual loan, at the loan level, and then at the bond level, protected by that 10% of either insurance or the subordinated part of some kind of, tranched security. I know that might not be entirely clear to everybody, but I think that's as detailed as I'll get on that for right now. So within this new system, the entities that would be touching the process include, of course, the originator. Then in some cases, there would be an entity bundling the loans. Sometimes that will be the originator. If you're Wells Fargo, you can pool your own loans. Sometimes it would be another entity. The bill provides for a mutual, a co-op structure for I'd say small lenders, but it's no longer really small lenders. It's really everybody except the 4 or 5 biggest banks could use this mutual to do that pooling of loans together. Then whoever pools the loans has to go out and get this insurance, which they do one of two ways: from a new type of entity that the bill calls a bond guarantor, or just to go out into the capital markets and structure a transaction where investors take that position. So you might ask, where do access and affordability issues and housing counseling issues fit into all of this? So there are a few different aspects of the bill that are important. First, one of the things that would happen in the new system is these securities would actually be manufactured. The part that all the mumbo jumbo that happens to all these loans as they get packaged into a security. That would happen through something of a public utility type bond-making machine, often called the securitization platform. And in order to use that platform, at the time you use it, whoever is delivering the loans to the platform will pay a 10 basis point fee that will go into a pot of money aimed at supporting affordable housing. The pot of money goes to 3 different funds. 2 of those funds are the funds that were established by HERA in 2008, the National Housing Trust Fund, which is a block grant program to help states produce affordable rental housing, or the Capital Magnet Fund, which is a fund run by Treasury that assists CDFIs with also providing affordable housing, rental or home ownership. Then those funds already exist, although they've never had much money in them. Then they would create a 3rd fund called the Market Access Fund, and that fund would be aimed at helping participants in this new system meet their obligations to provide equitable access to all creditworthy borrowers and communities. So there's this money, but what other ways are there that this new system can possibly incentivize the lending to the communities that we all know can easily get left out of a new system? Well, there's this other system that they've set up within the new government insurance agency, which is called the FMIC, or FMIC, people seem to be calling it. There's something called the Office of Consumer and Market Access. That office would administer the Market Access Fund, and it would also be keeping tabs on the primary market to see who's getting lent to and who's not getting lent to. Then the office will set up an evaluation formula looking at how different entities in the system are serving a list of underserved communities or products. And these entities will get ranked against each other, and they'll also get ranked against the primary market. And based on that ranking, that 10 basis point fee that you pay to get to use the platform could be adjusted downward or upward, meaning if it appears that you're serving underserved communities well, you might pay less than 10 basis points. If it appears you're serving them poorly, you might pay more than 10 basis points. And the formula would have to work out in a way that the total amount of the fund was the same as if everybody was paying the 10 basis points, so that you don't end up with less money just because the entities are doing a good job serving communities. What is not, there are 2 things that are not in this bill with respect to access. One is there are no more housing goals like the Fannie and Freddie housing goals. The Fannie and Freddie goals are explicitly repealed, and there's nothing that replaces them in terms of, numerical targets to hit for serving LMI communities. The other thing the bill does not have is an explicit so-called duty to serve, meaning the bill does not obligate the private participants in it to do any business other than what they are incentivized to do by this sliding fee scale. Another relevant part of the bill is that there is a down payment requirement, which is generally speaking a 5% requirement, with an exception for first-time home buyers who can have a 3.5% down payment. While there is some language in the bill related to fair housing and fair lending, right now there are some problematic sections of the bill that appear to undercut enforcement of fair housing and fair lending laws in this new system. And obviously that's a big problem. So before I kind of talk about where housing counseling might fit in that system, Bruce, was there some other big picture thing you wanted me to mention?
No, I think that's good. That's enough.
So the bill does not, unlike previous iterations of the bill does not prohibit housing counseling or, have language that appears to prohibit it. So we'll consider that a victory. Within the bill itself, sure.
So just to explain, so there was a provision in the other bill, the earlier bill, Corker-Warner, that had a list of things, activities that were prohibited, including personal counseling services, which nobody knew quite what that meant, but Julia helped us point out that it could easily be defined as something that might limit housing counseling. So in the new legislation, there's a specific provision in there that says that personal counseling services does not prohibit housing counseling as part of the legislation. So that was a big win, one that we had lobbied on. More small win, right?
Right. So there are some things that the bill could do but doesn't do. For example, I know that a number of folks on this call have tried to include housing counseling as something that would help offset any particular down payment requirement. And at the moment, nothing like that appears in the bill. The one place housing counseling does appear affirmatively is in the Market Access Fund. It appears as an example of one of the things that Market Access Fund could provide support for, but it's not required. It's just in a list of things that it could do. I will additionally mention there that of the total amount that will be collected through this 10 basis point fee, it's divided up quite unevenly among the different funds, with 75% going to the Housing Trust Fund, 15% going to the Capital Magnet Fund, and only 10% going to the Market Access Fund, which does disadvantage those functions that the Market Access Fund would perform, because there would be significantly less money in there. And certainly that's one thing I think we want to improve.
We would agree with that. Is there any way to price what kind of money you're talking about in those funds?
So the way that the 10% basis point fee will work, it's not really a one-time fee. It's really a strip, kind of like the way servicers are paid now.
So regularly, every month, right?
It would be, probably, I think it actually says annually in the bill.
Okay.
There would be this, you would get 10 basis points of the whole book. We would expect after the system ramps up to speed, which from soup to nuts takes about 10 years, the amount in the system would generate about $5 billion, which is quite a lot more than the current system that's supposed to fund these trust funds. And so, 10% of that is $500 million.
And that would be a year.
The bulk of it goes to the trust fund.
And so that would be $500 million in each year.
Each year, eventually.
Once it's
it would be cumulative, so it would build up over year, over time.
Right.
Because it doesn't apply to existing securities. It'll be as these securities are created, and that's based on the ultimate size of the market, but it's going to take a while for the market to kind of flow through from the legacy system to the new system.
Good. So, so those are the two.
I'll add one more thing, because there's one other
Okay.
area where I think housing counseling is relevant. You know, in addition to just the down payment per se, there are also the FMIC will be setting underwriting requirements, and there may be some room in there generally for some kind of counseling-related support.
Okay, so the FMIC is the securitization platform. That'll be the institution that handles these mortgages. And on the underwriting, is the idea that that would be in the legislation, or that that would be up to the FMIC to decide those things?
So the FMIC would have the sort of final say on the underwriting, much like Fannie and Freddie do now. The legislation does say that the standards have to be similar to the QM standard. It doesn't say they have to be identical. And this is one of those Rorschach tests where some people looking at that language think that it's meant to send a message that they'd like to see a more generous, access-friendly definition. And other people look at it and see that it's meant to, oh, okay, you know, QM is it. You're just supposed to do QM.
And then FHFA would go away under this world, and how does that work?
Actually, FHFA would get subsumed into the new agency, this FMIC. And initially, and I think this is meant as a carrot for Democrats to get on the bill, initially the current FHFA director, who of course is Mel Watt now, would kind of run this thing while it was getting up to speed. And then ultimately there would be a leadership transition, but FHFA would continue to have a role with respect to the Federal Home Loan Banks.
And Fannie and Freddie, how would the transition
And Fannie
work
and
with
Freddie
that?
go away.
And they would be transitioned
Fannie
over
and Freddie
5
get right. They get wound down over time.
Right. So a lot to absorb here. So you kind of referenced this a little bit. Obviously, many in our field feel like that it's a mistake to have down payment requirements in legislation, and that a number of the groups on the phone have run very successful programs where the down payments have actually been lower than 5% and even lower than 3.5%. And many of the product challenges that happened over the foreclosure crisis had much more to do with the structure of the product and the way that they were sold to people than what the down payment requirement was. So a question, and we're all among friends here, is one way to think about this is just to argue that they shouldn't have any requirement around down payment assistance, down payment requirements, and we made that case, I think, pretty strongly, but it still showed up in the new legislation. There was this whole, the 3.5% is down payment requirement is for first-time home buyers, but then after that, everybody's required 5%. I mean, should we continue arguing that they should just do away with that part, or should we take a more tactical approach and say that there should be, well, if you're going to do the down payment requirements, at least make an exception for somebody who's successfully completed an appropriate housing counseling program?
You know, my judgment on that is that it's okay to continue to push for there to be no number in the statute. I think it's unrealistic to push for no mention of down payment at all, which is, you know, was certainly the first choice of a number of us. I don't think we are going to win on having no number in the statute, so I think having housing counseling as an explicit exception would be very useful, and you might be able to get traction on it. You know, to be clear, the 3.5% exception was a big win already. You know, there had been Republican senators basically saying, you know, the 5% is in there and that goes away over my dead body. And this did manage to get in there and no one actually died. So, you know, it was a win, but obviously it didn't come out where, you know, those of us on the phone think it ought to have. I think there's still room on this. What I've heard from the committee is that this might be more winnable on the Senate floor than it is in the committee. But that doesn't mean we shouldn't keep on the pressure even now.
Okay. And Matthew, have we got some
you
questions?
know, they certainly, if they felt like we were happy, they would feel like they had done something wrong.
So Matthew, got some questions lined up?
Yes, we have a couple questions. The first is, under Johnson and Crapo, would the FMIC have the authority to adjust the risk rating of loans that have been counseled, thereby enabling funding from the insurance fund to pre-purchase counseling?
I'm not sure I entirely understand the question, but, you know, right now there's no particular provision for that, but, you know, one of the possible uses of the Market Access Fund is to provide support in a way that would change, you know, we'll call it change the government attachment point for pools of loans that have been counseled. Or just to support housing counseling generally.
Well, okay. Could you just explain that maybe in more plain
English?
terms? Yeah, right.
So there's this idea that you have to have this 10% private capital in first loss position. So just to say a little bit more about that, that's a huge amount of money. There will be those out there who will tell you how tiny an amount of money that was, but if there had been, if Fannie and Freddie had held 5% capital, they never would have gone broke during the worst of the crisis. So 10% is, I think most people in the industry consider it to be pretty serious overkill. And from our point of view, it's likely to make mortgages a lot more expensive than they need to be. You know, for us, it has not been a priority in our lobbying just because industry is so appalled by it that they're carrying the water on it, and we're trying to focus on, you know, the stuff they don't care about. But that attachment, so, you know, the 10%, that's, people refer to that as the attachment point. You know, after you get through 10%, that's where the government guarantee kicks in. And so it might be that you had a pool where, because the loans were safer, having been through housing counseling, that attachment point could be different. Maybe it would be, you know, 5%, because there would be less concern that you would blow through all that capital and hit the government guarantee. Does that make sense?
Well, that's a pretty exciting idea. And in general, if there are other ways to think about if the cost of money were cheaper if counseling was done, then, so that's one of them, but there might be others that we could think about in the context of FMIC, right?
Right, and you know, the thing about counseling, you know, it's a loan by loan thing. So it is a little hard for me to wrap my mind around the concept of, you know, all counseled pools, but it's an interesting thought. And there would also be ways, you know, on the front end, and the front end is the down payment, of course.
So I think what we could also imagine is that it's a mixed pool, so that the mortgage pool might have 10,000 mortgages in it, of which 5,000 are counseled, and with the Uniform Mortgage Database Program and tracking now through the systems that we think we've created, you'd be able to identify that this portion of the pool would be counseled, and then presumably you could factor in on the pricing.
Right.
Back, yeah,
right.
So that makes that easier. So this is an exciting question that actually it looks like it was Matthew Reby from NFCC has raised on figuring out how to build the pricing in, and we should pay attention to follow up on how to make these things happen more. Matthew, have you got another question lined up?
Yep, just I think a quick one. Will there be any funding for delinquency counseling?
So the stuff I talked about that refers to housing counseling in the bill doesn't distinguish between pre-purchase and post-purchase counseling. But I will mention that the bill does have a number of provisions related to mortgage servicing. They're really in two parts of the bill. One is that the FMIC will have to approve servicers to be in the system. And so much like Fannie and Freddie have now, servicers who wanted to service the guaranteed loans would need to meet certain requirements, including offering loss mitigation and offering affordable loan modifications. That set of requirements also gets pulled in on this new platform will have a uniform securitization agreement, which, AKA a PSA, that will govern the mortgages. And that PSA, first of all, it would be standardized, just as Fannie and Freddie's is now, and it would include requirements in terms of servicing loss mitigation.
So, and I think it's, and we've sort of worked on this some as well. We're trying to communicate that how important it is that every homeowner have access to the full range of loss mitigation tools, so that principal reduction would be available to everybody, that sort of thing.
Right. And there is a provision in the bill. Well,
it's uniform, but we don't know what's in it.
It raises a lot of, there are a lot of questions, there's a lot of discretion left to FMIC in exactly how to write the servicing rules. It doesn't prohibit principal reduction, and it also does explicitly provide for an underwater refi program like HARP in the event of a housing market downturn.
So, and Maxine Waters has introduced a bill. How is that different?
So what's interesting is it's not quite as different as we thought it would be, and Waters staff did work closely with the Senate Banking Committee, for the last number of months that everybody's been off in the dark room doing this stuff. The core difference between the water system and this system is instead of having these multiple entities, these aggregators and issuers and bond guarantors, and these, pure capital markets transactions, the Waters bill just envisions one big entity, a big co-op that buys loans, aggregates them, issues the security, and provides that first loss position. In the Waters bill, it's 5%, not 10%. Many of the other aspects of the Waters bill are similar to Johnson-Crapo. The basic structure of having private capital stand in first loss position is the same. The FMIC structure is pretty similar. The other thing that's different about the Waters bill is that they do have in that bill an explicit duty to serve, with regulatory authority for the FMIC to force the co-op to lend to underserved communities if they aren't doing it of their own volition. There are some concerns that even in the Waters bill, which is, certainly Waters is more consumer friendly on a lot of this stuff, the duty to serve isn't quite as strong as it could be. It doesn't really provide much by way of metrics or benchmarks or anything. The Waters bill, also not surprisingly, has a much more fleshed out section with respect to servicing standards and explicitly provides for principal reduction.
And we've got another question in the queue here.
Oh, and the good news about the Waters bill is it's less than half as long.
Only 200 pages. No? Okay. All right. So, and then just what's the political reality of all this? So, we know that there's total dysfunction between House and Senate on getting bipartisan legislation through. How realistic is all this, and does it make fighting around these things worth it?
Well, I'll answer that in the reverse order. Fighting around these things is worth it, even if it's not realistic. You know, many people may feel that Fannie and Freddie under conservatorship, particularly under the direction of Mel Watt, who is certainly, you know, moving things in a direction that I find, you know, warm and comforting. The system we have now is unstable, and it's unstable for a couple of reasons. One is the entities have been in conservatorship for almost 6 years now, but the rationale for the conservatorship has expired. Fannie and Freddie are now pretty consistently profitable, and not really. I mean, they're not going to stay profitable at the level they've been returning profits recently, because that's been sort of artificially pumped up by them taking a bunch of deferred tax assets and by all the settlements they've had on their repurchase requests. But you know, they do have a very, very clean book of business right now and are expected to continue to do fine as long as we continue to have, you know, if not a robust economic recovery, then, you know, not another recession. So at any point, the conservatorship could end. If it ends, we go back to the system we had before, which is a Fannie and Freddie who are governed by private shareholders and who have to return, you know, who have to be mindful of the returns that those shareholders receive, and also this so-called implicit government guarantee, where, you know, that's now really become quite explicit because we now all know that the government is going to bail out Fannie and Freddie. So there's still that aspect of what some people have called privatized gain and socialized loss, in that if the enterprises make money, the people who get rich off of that are the shareholders, whereas if they lose money, the people who lose money are the taxpayers. So that, you know, if conservatorship ends, you just go back to the status quo, which, you know, has been functional for a long time, but there have been a lot of problems over time because of some of those mixed incentives. Or you have some kind of legislative reform. Whether the legislative reform looks like this or not, I don't know. Politically speaking, things are only going to get worse rather than better if the polling is to be believed. But I feel pretty certain something is going to come out of committee. And this is the chance to kind of cement some consensus around some really, really important first principles, one of which is just that a government guarantee and the 30-year fixed-rate mortgage are important enough for us to want to continue them as a, you know, to make a commitment to that as a country. And that's not a position taken by all Republicans. So the fact that there are Republicans supporting that basic principle, you know, it feels important to have that, you know, a little bit locked in a way by a committee vote. Not that, of course, I mean, there's nothing legally binding about it. The next Congress can do whatever they darn well please. But generally the way legislation, you know, most big pieces of legislation don't happen the first minute they're proposed. They tend to marinate over the course of several years and be introduced in successive Congresses, with different iterations. And so, since this is expected, at least politically speaking, to be the high water mark, it would probably be useful to pass it. That said, there's a lot about this bill that I find concerning, as someone who is in this debate to help protect the interests of LMI borrowers and communities of color, low wealth borrowers. It's not a system that I feel like has enough protections in there yet, but I think the markup is a place where we can make significant progress.
Excellent. Well, we really appreciate this. I mean, this was a pretty deep dive in a small space of time and very, very helpful. We will stay in touch with you about these issues, and we will try to coordinate on the kind of positions we take so that we can be kind of on the same page when we can be.
Excellent. Well, thanks so much for having me. And, of course, I expect in a couple of weeks there will start to be more of a flurry of sign-on letters and specific amendments that are being shaped. And so let's all stay in touch with all that.
Excellent. Great. Thanks so much, Julia. Okay. Well, that was pretty interesting. A quick education in financial reform and housing financial reform. Okay, some very quick things here. So on MHA, as you all know, we spent a lot of effort in the early days of NHRC and to create a program that took HAMP funding and used it to fund housing counseling. What came out wasn't quite what we had expected. It's the MHA Outreach and Borrower Intake Project, and a number of your organizations are working in it. And frankly, the Treasury has said that the numbers aren't that high of referrals going through the program, and I think for very understandable reasons. It's the same funding level as NFMC. In fact, what the requirements are very similar to NFMC and doesn't help people beyond the initial application process in NFMC. So good to have some money for outreach, but this is basically unused money that's sitting on the table, and we understand that if there were real volume in these programs, that there might be more money available. And underneath that is that there's, I think, something like $14 billion in unspent HAMP money, or expected to be unspent, and what a loss this would be if we weren't doing everything we possibly could. So what would be very helpful right now is if your organization has signed up for the MHA Outreach and Borrower Intake Program, either directly because you're an intermediary or through an intermediary or through an HFA, then we would be very interested in convening a conversation about what should be done to fix the program. And there'll be other talks about what to do with HAMP funding, but specific to this MHA program, this is one that's in place because of the rules of the game with HAMP, that no new programs can be created, but this is an existing program that could be adjusted to make it work more effectively. So what I'd like to encourage you to do is simply, if your organization is currently signed up for the MHA Outreach, even if you haven't used it, could you just put your information in the question box, and then we'll have a list of groups that we can tap into, and we'll convene a call soon where we'll just have a chance to talk about how this program might be converted to make it more effective and more useful for you in the field. There's a particular moment in time where the administration's looking at other things they can do that don't need to be done legislatively, and while there's a long list of what those things might be, this is a particular one where we don't know enough, and we need your expertise to help us figure all this out. So please jump on the bandwagon with by putting your contact information in the question box, and we'll assemble a communication loop from there, and it can be very helpful to shaping what might happen in the future. Another big question that was a major topic of discussion at the Leaders Conference in Los Angeles, and many of you have been have talked either with me individually or in other contexts, has been how do we prepare ourselves going forward in the digital future. And frankly, what we are hearing from the financial services industry, from banks that we work with, are that many of our agencies, while they're doing great work and are protecting the identities of their clients, are not anywhere near up to speed in the kind of encryption and protection levels that are required to do work that might be funded by banks or through Treasury. There's this whole question of how do we get organizations to paperless files? How do we get organizations to have up-to-date systems? Are there ways that we can make the communication and CMS systems more easily available to people and require less work? Can we get all these computerized systems, in fact, make our work more efficient? All these kind of big questions are out there, and we're trying to figure out how to get our arms around them. And we know that there's a range of organizations, some of which are very sophisticated about their technology, and some of which are, operations that are for staff people in an office and with out-of-date computers, and a lot of range in between. So we've got a working group of people that are going to start meeting and talking about these kind of issues and how to get our arms around it. We'll do some thinking. We're particularly interested if there are others that want to be a part of the conversation and maybe who aren't as sophisticated on the technology side, but sort of understand the need, because partly we need a broad range of voices in this conversation so that we can have a better sense of what's needed. And, we need some people who are willing to speak up for the people who aren't techno-geeks and aren't experts in the field, and we need that voice represented in this conversation. So if you're interested in this particular conversation, please shoot me an email. I'll put you on the loop. We're going to start convening meetings shortly and maybe even do some field test hearings and meetings coming up. We're also planning a meeting in Tampa, Florida, and we'll get the announcement out on that shortly. But if you're in the Florida area, Sylvia Alvarez's group is sponsoring an event, and we're going to do a meeting jointly with the Florida Housing Counselors Network. I think it's on the 17th, but I'm talking off the top of my head here. But we'll figure out how to reach out to groups in that area, and if you're interested, let me know. But that will be really kind of a broader conversation about counseling, and we're trying to hear from the field about what people want to work on and tap into opportunities. Very quickly, as you know, we did a lot of work on HSBC, and they've made some changes. They've got a sort of a training orientation webinar coming up. That information's on your screen right now. Thank you, Matthew. And we'll post announcements on the listserv, but wanted to make sure it's on your schedule, and it's for the 21st of April. And then just one more reminder, we may keep reminding you about this, but we understand that this still hasn't worked perfectly. So the CFPB has this Find a Housing Counselor website. It will probably become the resource that that individuals use to find counselors, and lenders and servicers use to list counseling agencies when they have to alert people about the availability of counseling. And we continue to find that agencies aren't always listed as they would like, that there are mistakes on the listing, and it seems to be a lot better now in terms of getting all the agencies listed. But make sure that all your affiliates and your offices and your branches are listed properly. If it's not, the first step is to go to HUD and to your point of contact at HUD and figure out with them what needs to be done. If it still doesn't work, then you could reach out to me, and we've established a bridge with the CFPB, and they have gone in and troubleshooted. What's the word there? Troubleshot, whatever it is. They figure out how to fix the problem or communicate with HUD to fix the problem. But first stop is the HUD, and this is an important tool of our work going forward. So wanted to keep reminding people that it's important to make sure you're listed properly. The last thing is we've had a rush of members into the National Housing Resource Center. Really thank you for all the ones that have joined, but feel free to, we would love to have more members. We still have a discount available for credit reports. We still will have some, webinars that are specific only to members and some resources that will be very valuable. But this is what really keeps us going and allows us to do the work we're doing. All right, well, we've had a very good 2 weeks since our last meeting, and really appreciate all the support. You guys really did blow it to the roof on this sign-on letter, and we really, this has become a useful tool. We've gotten very good feedback from a number of the House and Senate offices from it. All right, thanks everybody for your good work, and we'll talk to you in 2 weeks. Bye.